with all the theory and some of the background information behind us, we're now going to get involved with today's material. A lot of you have seen this before. Concepts will keep coming back. We'll keep referring back to them and falling back on them for justification of what we're doing. But this chapter is going to lay the groundwork for the mechanics, the debits and credits, key accounts, journal entries, and the most important thing, if you haven't noticed, if you haven't started reading this book, is that in every analysis of a transaction, we go back to the four basic general purpose financial statements: the balance sheet, the income statement, and the statement of cash flow. So the way you need to think, I guess, in using this book, not only using the book, but actually going forward, is to make sure when you look at a transaction, you analyze it. It's got to be recorded, journalized, posted, but the primary factor at the end would be what financial statements are affected and how. Now, we're going to start with the balance sheet. So we're going to go over that again. And of course, we know that the balance sheet is also known as the statement of financial position or the statement of financial condition. The balance sheet is simply a listing of assets, liabilities, and stockholders' equity at a particular point in time. As I mentioned, it is what is called a position statement. It's a stock of wealth. If you want to look at it more deeply, we know that it is going to have accounts which are cumulative in nature and they're permanent in nature. So these balances carry forward period after period, and they represent incomplete accounting cycles. An incomplete accounting cycle has implications for future periods. Now, the balance sheet, this happens to be Target's balance sheet. Of course, we know that assets have to equal liabilities and stockholders' equity. And of course, these are, when we look at the assets, liabilities, and equity separately, I'll provide you with these definitions. So now let's look at the elements of the balance sheet. The assets will be first. Assets are going to be the uses of funds. And by definition, the assets have to have the following characteristics. They must be owned or controlled by the company. That means they either have legal title or unrestricted access to use the asset. They have the right to control the asset. Now, the control of the asset means that you could lease an asset and get the same economic benefit as you would if you would have purchased that asset. And those benefits, the expected future benefits, are where we would find that you're going to be adding to shareholder value. One of the things that we commonly say is that when an asset is recorded, we say that it is capitalized. The term capitalization in this regard means to add to an asset account. So when you see the term capitalization, it means to add to an asset account. Now, if anyone majored in finance, capitalization also means, and let me go back to the equation. If you look at the equation, sometimes, if you're in finance, you're going to say, what's the capitalization of the firm? It means it's debt and equity. How does the company capitalize? Well, it kind of makes sense that when you add something to an asset, you also capitalize it. So that's where we get the term from. Capitalization means to add to the asset account. Now, the benefits are going to be revenues. Of course, they generate expenses as well. But when we look at the benefits, they could either be the receipt of cash or other assets or reducing liabilities. Now, assets, of course, are acquired in order to increase value for shareholders, and we do that by generating revenue. So assets are basically designed, when we look at economic benefit, they're designed to generate revenues that's either directly or indirectly. A direct use of an asset is when you sell inventory. Indirect use of the asset is when you use the asset to either provide a service or maybe manufacture another product. Now, in any event, you hope that income in excess of the cost of funds will create that shareholder value. In other words, the profit on the asset itself should exceed the cost of the funds used to acquire the assets. And remember we said way back that, and I hate to use this with the screen up, so let me do that on here. There we go. So assets are uses of funds. Oops, did something I don't want to do that. So in this case, what we're saying is that there's going to be a cost of financing, a cost of funds here. There's going to be at a cost. And that cost is going to be either interest on debt, and there's a cost of equity capital as well, the required rate of return for shareholders. So what you're hoping for here is that the use of funds develop a result in profit that exceeds the cost of funding. And that's how we create shareholder value. Shareholder value is created when the profit generated from the use of assets will exceed the cost of funds. So in order to, and think about this yourself, if you opened up your own business and you had to borrow money to buy a vehicle, let's say for delivery purposes, the interest on that, the cost of borrowing, and of course there are other expenses as well, but just look at the cost of the financing, you'd have to be sure that you can return a return or a percentage in profit greater than the cost of financing. And that's how we create shareholder value. Now, when we look at the assets of a company, let's go back to the PowerPoint. If you look at Target's assets, and we're going to look at the assets themselves, the assets are listed in the United States. We list them in the order of liquidity. And what's liquidity? Liquidity is the ability to convert an asset into cash with minimal risk of loss. So when you look at liquidity, it is the ability to convert assets into cash with minimal risk of loss. And those assets are, as you can see, listed in the order of liquidity. Cash and cash equivalents, by the way, cash equivalents we'll get to. These are near cash items like treasury instruments or money market funds. So cash is the most liquid of Target's assets. Then inventory, and don't worry about the discontinued right now, other current assets. These can be prepaid rent. And when you talk about liquidity, you're talking about the ability to convert those assets into cash. So cash and money market funds obviously is already very liquid. Second, inventory, well, when you sell it, it's probably an easier way to get cash than go to the fourth asset, other current assets. This could be prepaid insurance. Maybe Target paid millions of dollars for insurance in advance. You can't really sell that easily. Or if you paid rent in advance, you'd have to sublease it. It may not be as easy as selling the inventory. So this is what we mean by liquidity. And this is decreasing order of liquidity. It becomes less liquid. It's harder to sell off a planned asset than it is to sell off inventory. So this is a decreasing order of liquidity. In the United States, the assets become less liquid as we go down the balance sheet. Now, IFRS, it's the other way around. Their planned assets are first on the balance sheet.
Would the other current assets be like itemized in a footnote or something?
Yeah, if they're significant. Right, so very good question, because what will happen is any of this other category, and Avi had the same, I think, in that same vein with his question earlier this morning, that individually, items may not be significant enough to disclose them separately, but in the aggregate, they're material. So other assets are material, but individually, there may be very many insignificant items.
Would they be not big enough to be constituted as an account?
As a separate category,
Okay.
yeah. Now, they are separate accounts, but they may not be significant enough to break out separately. So we're saying that this is a perfect example of materiality. That I'm going to say to you that Other current assets like $1,745,000,000, that number is significant, so you have to know that. But you probably don't really need to know that, $2 million of that is prepaid rent, $1 million of that is supplies. That would be distracting if I put it on the balance sheet. So it's too cluttered. So this way, if you need that information, you might be able to find it in a footnote. Okay, it's going to be there somewhere. And even the footnote can be aggregated too. Because that's one of the things you do in auditing. You're going to start rolling up accounts into balance sheet accounts. You're going to be rolling up the details. So it's a very good question. And notice also that the balance sheet is going to be broken up into current and non-current assets. Current assets, we say, are consumed within 1 year. Actually, it's 1 year or operating cycle, whichever is longer. So when you define something as current, I'm going to try to put it, I know it's hard with the screen up if you're in the corner, but hopefully you can see this. If it's current, I'm going to try to confine it to this corner. So it's 1 year or operating cycle, whichever is longer. Now, what types of companies have operating cycles that are greater than 1 year? Well, first, to answer that question, let me just tell you what an operating cycle is. It's the company's cash-to-cash cycle. So let's say you're starting a business and you're going to sell some inventory. Let's say it's retail, a retail company. You want to sell inventory. So you put some cash in, and then you get some credit. We'll explain the details of this later. Got accounts payable, then you have inventory, then you have a sale. A sale on credit generates accounts receivable. Somebody owes you money, and then it's back to cash. Now, that generally takes less than a year. A lot of companies have multiple cycles, right? And again, we'll talk about what you do with this later. Obviously, the cash, the first thing you do is you pay off the creditors, and then let's forget about excess cash for a minute. Second, then you put the cash back in the cycle. All right. So just something very, very common. You start your own business. You buy inventory, you need some credit. I use a credit card, it's an accounts payable, you have to pay it. You sell inventory, you don't collect everything, it's an accounts receivable, and then you finally collect it. What types of businesses have a cycle like that that's greater than a year? Can you think of anything? We spent a lot of time on this later on. Yeah, right, long-term construction projects. Take a long time for more than a year to go from cash to cash. Also, I always use the example, anything that's kind of like not really good for you, like cigarettes or alcohol. If you look at tobacco companies' balance sheet, it'll say that we have leaf tobacco in inventory. It has to be cured or aged. We have leaf tobacco in inventory that we're not going to be able to use for 18 months, but it's a current asset. So it depends on the industry and the company.
Maybe similar to like a wine distillery?
Yes, wineries, right, yeah. So anything that has an aging process would be a cycle greater than 1 year. So it's generally 1 year. So for the accounting 101 kind of examples that we'll have, it's always 1 year, but it could be longer than a year depending on the cycle. Shipbuilding, aircraft manufacturing, any type of construction, anything with an aging process would have a cycle greater than that. So 1 year operating cycle, whichever is longer, more than 1 year or more than an operating cycle.
Quick question, like what
Sure.
about companies that invest in like real estate? So like they have like multi-family homes and apartment buildings?
Yeah, that would be like a construction.
Okay, so it would fall under that
Yeah,
category.
like a development, land development projects
Yeah,
and things like that.
but they're getting cash flow from rent and things like that, but at the same time, they take out a mortgage on it, so. you
Yeah,
get-
they still have, well, what they would have is an ongoing, and that's the whole thing when you analyze a business, you've got ongoing cash flow. So everything's gonna kind of like overlap in a sense. So when you start a new project, it doesn't mean that you've got no cash at all. So if I'm a construction company, it doesn't mean I have no cash at all. But I've got projects starting at different points.
Okay,
So you got some cash coming in, and in some cases, the cycle takes long.
but like the property itself would be considered a current asset, even though it's contributing to cash now?
No, I mean,
or-
in that case, well, yeah, I mean,
I guess that's
if
what-
you're selling it within a year,
Okay, got it.
or operating cycle, it's part of your inventory. So that's a real good question. We'll see that like later on in, maybe like next spring, actually, intermediate two. Construction companies have construction in progress, land development. So as they're building houses, they may sell a couple of them, but houses that are still in inventory would be their current. Even though they may not sell them for another 18 months, 20, 2 years.
Okay, so I guess where I was confused, it could be pretty much the same thing. It could be two houses on the same block, but depending on the expectations and what they're going to do.
Yeah, one could be sold and one could still be held in inventory.
Okay, got it.
So I know on the balance sheet, you said you have to go from where, from most liquid to least liquid?
Yeah, in the
But-
US, yeah.
So is there any instance where like the current asset would be more liquid than like one of the assets on top, or usually the ones that are on the bottom?
No, this is all done based on the expectation, as you used the term before, as when it's gonna be converted into cash. So you've got a planned asset that we don't expect to convert into cash within a year operating cycle, it's gotta be non-current. And there's a reason for this, we'll show you in a minute.
Would you distinguish between different currencies based on, cost to convert and stuff?
Yeah, so in other words, if there was any foreign currency involved here, it's gonna depend on whether or not it's an investment or whether or not you're valuing a subsidiary in a different country. And we'll see that throughout this curriculum as well. Okay. All right, so that's the asset side. And again, please realize, and we're gonna go through the definitions now, we've already done some of them, just gonna highlight a few. But please realize again, that if you're looking at, a financial statement under IFRS, statement's upside down, I guess, well, right side up to them, but upside down for us in the United States. They start with the non-current. Planned assets are the first assets up on their balance sheet. All right, so now the categories, current assets, again, we define as assets expected to be converted into cash within a year operating cycle, whichever is longer, listed in the order of liquidity. US GAAP is decreasing liquidity. Non-current assets, obviously after current, not expected to be converted into cash, sold, or used up in operations for a period greater than 1 year operating cycle. We sometimes call these non-current assets. We sometimes call them long-term assets. And again, this is all part of that going concern concept. If you didn't have the going concern concept, everything would be current, because everything would be expected to be liquidated within a year. All right, so here are the assets. We know that cash and cash equivalents would include certificates of deposit, currency, coins, money market funds. Cash equivalents, again, are very liquid investments that will mature very quickly. Like a treasury bill, a very short term, a money market account. You have access to cash immediately. It'll be current. It's a cash substitute. And by the way, that happens quite a bit here, where sometimes in this cycle, if you have excess cash, you might divert cash to some investments, and we'll talk about that a little bit as well. All right, so now you got receivables, or marketable securities, I should say. Marketable securities, these will be other than cash equivalents, short-term investments in equity or debt securities that you expect to sell off. And by the way, again, if you have excess cash in the cycle, you could always invest in those securities. Accounts receivable, this comes from the sale of your products. This is what customers owe to you. By the way, this would not be credit card sales. credit card sales are cash sales. I don't know if you know that, because you get the cash right away. So, in a restaurant, for example, if you use your credit card, it's a cash sale. Because they get the cash, once they put in the receipts at night, I guess the bank credits their account almost instantly, at plus or minus a fee. So there's a 2% fee or a 5% fee, but you get the cash right away. So these are not credit card sales, but these are where you're giving your customers a line of credit or credit to buy from your company. Inventory, of course, these are items held for resale. You either buy them or produce them yourself. When we get into management or cost accounting, we learn how to value inventory. Again, these are just definitions. And then prepaid expenses. These are advanced payments that you make for rent, insurance, and other services. So, for example, if you prepay rent for 6 months, prepay rent for 3 years, prepay insurance, those are assets to you because they have future benefit. And as long as they have future benefit that could be used to generate income, they are assets. And they are generally current. Then we have the non-current. This is financial instruments. You might be holding long-term investments in debt or equity securities. You don't intend to sell them in the near term. Those are very common for especially financial service companies and even other industrial companies as well. Property, plant, equipment, buildings, equipment, land, any type of machinery, warehouses. These are your productive facilities. If you don't have brick and mortar, we saw the case of Nike where they outsourced. They have very little capital investment like this. You could lease these as well. And if you lease them, they're on your balance sheet as well. Sometimes leased assets are included up here or a separate category, as we'll see. So leased assets can also be included. Now, intangibles. Intangible assets, patents, trademarks, franchises, goodwill, we talked a little bit about. They provide future economic benefit. These are assets without physical substance but have value because of the rights that they confer on the holder. So you have a franchise, it gives you the right to sell a Toyota. A franchise gives you the right to sell McDonald's. These franchises could be pretty expensive, a couple $100,000. I think sometimes the franchisee has to prove that they've got backing of $400,000 even after they buy the franchise. So they're pretty expensive. But the key is that they have to be purchased. They have to be purchased. Internally generated intangibles are not recorded in the U.S. They are in Great Britain and other countries, but in the United States, internally generated intangibles are not recorded. For example, the Nike swoosh has no value on Nike's balance sheet unless somebody buys them. The Apple logo has zero value to Apple on their balance sheet unless somebody buys Apple and pays for it. So if you don't have an objective transaction, the asset cannot be measured. It cannot be measured unless there is an objective transaction. So internally generated intangibles are not recorded. And this is a problem that, we thought it was a problem for companies like Johnson & Johnson or even tech companies like, Siemens or SAP software, where they do all this research and it's expense. R&D is not an asset under US GAAP. R&D is an expense. So anybody in research and development, you expense it. It's not an asset, but it'll become an asset if its research is sold to somebody else or if you buy the research. So patents today, have very little value on a balance sheet unless you buy them. So most of your patents are going to be valued at the cost of registering the patent or legal defense, but there's no cost on the balance sheet because everything gets expensed. We don't capitalize research and development in the United States.
But if you hired an attorney to take care of the patent and things
Yep.
like that, wouldn't that
goes on
for a value?
Yes, that gives value. So
Okay.
patents today have a really nominal value
Okay.
because today, for the last 40 years or so, as a nominal value, because we stopped capitalizing research in the United States because of the uncertainty as to the future marketability of the product. So this was changed before I started auditing, but let's say you're auditing a company and they say, well, we're doing research on solar-powered automobiles. Okay? We're going to have solar panels, but we haven't really developed the car yet, but all the technology we're putting into this, we're using in our gasoline and hybrid cars. They can make an argument that the research has value. And because we're not certain, we said, you know what, we're going to expense everything. We took a conservative view, and we expense it. But it has value to the company in a lot of ways, but it just doesn't show up on their balance sheet. Now, all that shows up on the patent after it's registered is the legal fees and the cost of registering.
Okay, so they give it the value based on that, not like.
Yeah, it's not as significant as you would think.
Okay. Because
So
they
if
sold
if Apple gets a patent
Yeah.
for new software, you might think it's multi-million-dollar valuation. Well, that's how much they put into it, but very little of that shows up on the balance sheet.
Got it. So like if they had an awesome touchscreen software, really great patent, but it's based on the legal fees. It's not what they could sell it at on the market.
Right, that's right. Yeah. And none of this is at market value, we know. These would be at cost.
Okay.
Now, we measure assets we know at historical cost and fair value. And we went through this in the theoretical discussion, but just to review, historical cost has the advantage because it's representationally faithful, it's reliable. Disadvantage, it may not be relevant. We know that market values, especially quoted market prices, are used for securities. And we really don't worry too much about quoted market prices because they are reliable, they're objective, they're real-time stock quotes, so we don't worry as much about the representationally faithful values that we get. The problems come in when we look at the next levels. Fair values that are not at quoted market prices, the levels 2 and 3 I had on the board in the theoretical discussion, market comparables and estimation models. This is where, yes, we have relevance, but we give up faithful representation. So these are a lot less reliable. Market comparables are not as reliable as quoted market prices, and the estimation models are much, much less reliable than even the market comparables. So again, the fair value in this case are more relevant, but they're less reliable, and that's of course our trade-off, that we generally have relevance for reliability or relevance for faithful representation. All right, so the balance sheet is the listing of assets, liabilities, and equity at a point in time. Assets could be, as we said, current or non-current, and they could be measured at historical cost for the most part, fair value only for those marketable securities. Now, before we move on to the sources of funds, the liabilities and equity, anyone have any questions on the asset side or other questions? You had some very good questions, yes?
When a long-term liability, a long-term investment is going to become current because of the year it matures in, does that get converted into a current asset on the sheet? Okay.
Yeah, we do move, we're going to talk about that, we do move items based on their ability to convert to cash within that 1 year. I'm going to show you that in just a second. Let me just do the liabilities first, and I'll get back to your question. So the liabilities and equity, of course, these are the sources of funds. And we know that liabilities will be based on accounts payable. These are lines of credit, open trade credit that you have with suppliers. Accrued liabilities, that is the example I gave you before about the utility bill. An accrued liability will define it, but it's pretty simple. It just represents a liability that you've incurred but not yet paid. Like your cell phone bill right now, if you don't get it till the 15th of the month, you might have even got it now, but when that cell phone bill comes in, then you pay it. But you've been accruing that expense over the last month, and that's an accrued liability. So that would include utilities, salaries that would be accrued over time. Accounts payable generally represents the acquisition of inventory. So accounts payable are generally tied to inventory acquisitions. Accrued liabilities would relate to salaries, would relate to rent that gets accrued that you may haven't paid yet, cell phone bills, any of the type of utility. Salaries in your business would be liabilities that accrue over time. And then, of course, we have investors, bonds that we might issue. We may borrow from banks, and we list liabilities in the order of maturity, current to non-current. Equity, we know that it's either obtained from contributions by stockholders, stock purchase, or internal funds, retained earnings and reinvested in the business. Now, if you look at Target's liabilities, notice again they're listed in order of maturity. What matures first? Accounts payable matures first. Then you've got accrued liabilities. Forget about the discontinued. We will see that in later parts of the program. And then the current portion of debt, and Steve, I'm going to get to your question in a second. Those are liabilities that we expect to pay within 1 year operating cycle, whichever is longer. And then the long-term liabilities, long-term debt, and bonds. So liabilities that are due within 1 year operating cycle are current. Those that are paid in a period longer than 1 year are non-current. Now, when you look at the order, it's maturity date. Accounts payable mature faster than other debt, and then, of course, that's faster than the long-term debt. Now, the whole idea, and by the way, we'll talk about that in a second, but the whole idea of current and non-current is to try to help you match maturities, which I'll show you in a second. First, let's look at stockholders' equity. Stockholders' equity has either common or preferred stock. Amounts in excess of par value, we talked about that. That's additional paid-in capital. And then we have retained earnings, and we'll see the other as we get there. But common stock and additional paid-in capital, if you remember how that was explained, common stock is at par value, paid-in capital, that's in excess of par, and retained earnings are amounts that are earned but not distributed as dividends over the life of the business. So since Target started its operations, from the very day it started, those are its retained earnings. All of its net income, minus its losses, minus any dividends, that is the balance of that account over time. Now, getting back to Steve's question, the whole idea of the current, non-current classification is to match maturities. So that when you look at a balance sheet, let me just move this up so I can use the board for this. So the whole idea is to allow the reader to properly assess the company's ability to pay off short-term debt when it's due. So, for example, I'd have to look at the current assets to determine if the current assets are sufficient, liquid enough to pay off my current liabilities. I also, although I'm not as worried about this right now, my non-current assets would be considered a source once they become current. That was the question I guess you had, or the point that you were making. Once those become current, they'll be available to pay off maturing liabilities. So that's the idea of matching maturities. And current assets minus current liabilities is called working capital, which we'll see. We'll see that. Now, here's an example. I was gonna do this later, but since you asked the question, I'll do it right now. What if you had long-term debt? So here's an example. You have long-term debt, $10,000. It's payable $1,000 each year. How do you classify that debt on the liability section of the balance sheet? Anyone have any idea? Where would you put the debt? It's long-term debt.
Would it be 1 short and 9 long?
Yeah. So you've got, let me go back to the target statement. You notice in their current liability section, they have $91 million of the current portion of long-term debt. So in here, you have the current portion. Current portion of long-term debt. Sorry that I'm squeezing this in, but that's 1,000. And long-term debt is 9,000. Because the $1,000 is going to use what? Current assets to pay it off. And you need to know that as a reader of the financial statements. Now, as an accountant, you do the reclassification. Right? You're responsible to reclassify that debt as current. Because if you left that all as long-term, it would overstate the company's ability to pay off current liabilities. It would make it appear as if the company had more than sufficient current assets to pay off those current liabilities. All right, now here's another question. As I said, I was going to do this later, but since you brought it up, might as well get it out of the way. What happens next year? What does that balance sheet look like next year? So let's say this is 2016, 2017. What happens in 2017?
Still 1,000 for current, but then if long term is down to
Right.
80.
Mm-hmm. Yep. So every year you pay 1,000. Now, when you pay that, of course, the liabilities paid off. So you paid off the 1,000 from 2016. You got to pay them in 2017. But again, the idea is that you would have to reclassify the debt in order to match maturities. And that's the purpose of the current, non-current classification. Okay, so I want to be sure that we keep thinking, keep asking lots of questions, because if you just say, oh yeah, that's goes on the balance sheet over there, I don't know why, but that's the way they do it. No, you gotta know why. And it's there for judgment, it's there for the company's disclosure to allow the reader to understand the current assets that are going to be needed to meet those current liabilities. All right, any questions about that? I mean, that was a good point, good question, and I want to make sure that everyone sees that the liabilities have to be matched with the assets. The maturities have to match, and that's the whole point of the classified balance sheet. Yeah.
Could you pay more than 1,000 for it?
I mean, yeah, maybe there's an early payment clause. And if that happens, of course, there's, you may not have known that when you issued those statements. By the way, you know that there's a period of time when you audit a company. When does for example, when does a company with a December 31st year end release its financials? Does anybody know? An audit's going to take a couple of months, right? So they're going to release those statements somewhere in February. So if you did decide to pay that debt off before you release the statements, then you could disclose that fact. Okay, so you guys will be auditing from, well, okay, you'll be there in the winter during an internship, but the normal audit for a December 31st year end is going to start around September or October to do the evaluation of internal controls. Then after the close in December, December 31st, the year-end date, you come back in and you audit maybe January and February, maybe even half of February, because you can close pretty quick. And that closing is where you would, in that period, before you sign off on the statements, issue the statements, you got a period of time where things can happen. So you might be able to disclose it there. If you don't pay it off in that period, then there's nothing you can do. I mean, you already went through the disclosures that you had, that you made based on the information that you had. All right, any other questions? All right, now, liabilities may not be as simple as we think. So let's talk about what a liability is. Liability, and I'll put the screen down for you so you can see this a little better. Liability is a future or probable future sacrifice of a known amount, and you have to have an event that has occurred or a transaction that occurred, so that it will involve a future cash payment, and transactions that are executory in nature will not be liability. So a purchase order, for example, as they tell you here, would not be a liability. Now, I'm going to give you another example. What if you had something known as and I'll put this up on the screen, just want to move this on the monitor rather. Okay, take or pay contract. I saw that in General Electric's footnotes. And what this is a contract where General Electric engages a company to manufacture a component part. So let's take GE's aerospace division, and they need a component part for one of their jet engines. One is smaller. And GE agrees to pay whether they take it or not. In other words, GE could be engaging two companies to develop this, right? I mean, you got some competition. So I hire your company to do it, and I guess, Scott, how about you do the same thing, right? You do it first, I buy yours, but you already finished it. I still have to pay you. So whether I take it or not, I have to pay it. Now, is that a liability? GE signs a take or pay contract, is that a liability? Well, let's look at the definition. A future sacrifice is probable, right? Because there's no doubt I'm going to pay somebody, whether I take the inventory or not. I know the amount because I've already signed the contract, but has the event or transaction occurred on the date I signed it?
Well, if you paid them, wouldn't the transaction have occurred, but then not the?
Well, I'm saying right now I signed the
You have to
contract.
receive it.
I signed the contract. All I did is I engaged two people to develop this component part. That's all I did right now. And I promised to pay them whether I need it or not when they're finished.
Contract hasn't been executed in a way that.
Yeah, it's still executory contract. The contract has not been executed. What do we need to execute the contract? You have to finish manufacturing the product. So this goes into a footnote. This is not a liability because the event has not occurred. In other words, what if I come to you a year later and say, how you guys making out with the part? We didn't manufacture it. Well, that's it. If you didn't make it, I don't have to pay for it. So it's executory in nature, executory. And the same thing's true in a purchase order, but that may be too obvious. This is something that you see a lot in business where it has to be disclosed, but it's not necessarily an actual transaction. All right, so any questions on the liabilities? We'll look at some categories right now, but I think, the rest of this should be pretty fast because we've already done most of this. Yeah,
So going back to that real estate example, so
Yep.
I'm selling homes now, but I have homes that are long-term assets. When I sell those, then there also be long-term liabilities like capital gains taxes and things like that. Would I be factoring those in, or
what, the taxes?
the taxes?
Oh, yeah,
when I
yeah,
sell
no,
the
we will,
properties?
right, taxes are definitely a big part of the transactions. We basically work in a no-tax environment for a while, and then we bring it in.
Okay, got it. And if it's so far out into the future, what if, tax law might change or something like that? You just
Right.
go off the best of your ability, or you just,
Yeah, it depends on how it's accounted for. With respect to what we call deferred taxes, it gets kind of tricky.
okay,
So if we expect to pay taxes in the future, we may use the current tax rate, but if a new tax rate is enacted that we expect to be in effect when we pay it, we have to factor it in.
okay.
And you might be revaluing the liabilities for taxes
Right.
based on changes in tax rates. Okay, we will definitely see that. Okay, it's a good question. All right, so we know we have current liabilities, we know the definitions, we know them in the order of maturity. Current 1-year operating cycle, whichever is longer, and then of course long-term, if they're not going to be paid within that 1-year operating cycle. All right, so let's just go through some of them again. Accounts payable, as I said, these relate to inventory or services in your normal line of business. This is what you owe to suppliers or anyone that provides you services in your normal course of business. Accrued liabilities, these are obligations that have been incurred but have not been paid. You've incurred them, but you have not yet paid them. Like your cell phone bill, perfect example. Your telephone bill, you've got the obligation to pay it. You didn't get the bill yet, but you know it's coming. And you could estimate that, and that would be a liability for unpaid utilities. Short-term debt, this is where you have a line of credit with banks. Sometimes that line of credit is used to buy inventory. Short-term debt, shorter than 1-year operating cycle. And this one is pretty interesting. You got to get used to the term deferred or unearned revenues. These are advance collections. These are collections that you make in advance. So you got tons of these in practice. Subscriptions, season tickets to the Jets or the Giants, season tickets to symphonies, operas. Anything you pay in advance, the individual or the company that receives that payment has a liability to deliver the product or service. There's a whole new craze on these subscriptions, right? I mean, you may not think of Birchbox as a subscription or Dollar Shave Club as a subscription. These are all subscriptions. I mean, years ago, this is the way people used to buy milk and bread. They used to sign a contract and have home deliveries. And now, although it's much more high tech, you're getting food, you're getting, I know someone that likes Kit Kats that have dark chocolate of 72%. You can only get those in England or Europe somewhere. And apparently he's already got a subscription and he gets them delivered home. So, the same thing. So when he pays for those in advance, the company in England that's selling them has a liability. They have a cash inflow, but they've got a liability. And that liability is going to be paid not in cash, but it's going to be paid in Kit Kats or paid in a product or a service. So not all liabilities are paid in cash. They're paid in products or services. And then, of course, the current maturity of long-term debt. We just illustrated that with my example. We had to move that debt up by reclassifying. Long-term debt, long-term notes, long-term bonds. You borrow for more than 1 year. A mortgage, auto loans are long-term liabilities. And then finally, of course, others. We have various deferred compensation contracts. We've got various obligations. You can think about, Fred, you talking about this long-term tax liability. These are long-term or deferred liabilities out into the future. Those are subject to revaluation if tax rates change. Deferred compensation contracts. If you think about especially professional sports. How do you beat the salary cap? You just build contracts that defer the compensation, but it's still a liability from the standpoint of the sports franchise, even though they're not going to be paying it for several years down the road. All right, in stockholders' equity, of course, this is the residual interest. By the way, when we go back, just want to make sure that you understand that these liabilities and all the liabilities have a senior claim, so that when you look at, I think I mentioned this earlier, last week, but when you look at assets equal liabilities plus equity, the creditors have the senior claim against the assets, so we sometimes look at equity as net assets, assets minus liabilities, and that's why we look at this as a residual claim. That's a residual claim in the sense that it is the claim that remains after liabilities are paid off. So equity has a residual claim against the assets of the firm. Liabilities have to be paid first. All right, so that takes us to the equity. Any questions on the notion of the senior claim? Liabilities must be paid first. So the equity holders, liquidation would only get what remains after liabilities are fully paid. Now, the residual equity includes contributed capital. These are amounts that are paid in or contributed by the stockholder. This would include common stock at par or stated value. It could be preferred stock as well. I already mentioned, I believe, what the par value is, but that's the face value of the stock. The par value is a nominal amount, as we said. The stated value could be placed on the stock by the board of directors. It has the same effect. If you pay in more than par value, then you have an excess over par, or if you pay in more than stated value, that's going to be the additional paid-in capital. Additional paid-in capital are in excess over par value. It is something that we're kind of stuck with in terms of the accounting. It doesn't have much legal significance, so that, again, I think I gave you an example. If you issue stock, put that down. Oh, this is not, that's why. With a $1 par or stated value, either one. And the issue price is $15 per share. On the balance sheet, it's going to have par value or stated value. Is $1, and the additional paid-in capital is going to be 14. So the amount that's paid in is $15. The amount that's paid in is 15, and the par value or stated value is $1. The excess over that amount is the additional paid-in capital. Now, as we said, the par value doesn't have much legal significance, doesn't have much economic significance, but the additional paid-in capital is broken out separately. There is a reason for that. It has to do with legal capital in some states. We'll talk about that when we get into this more deeply. Right now, that's where the accounting would take us. If you sell stock for $15, if it is a $1 par or stated value, you have to split that up between the par and the excess over par value. And that's known as APAC, or additional paid-in capital. And then finally, treasury stock. That's the cost that you pay to reacquire your own shares. And I think we talked about this a little bit. You buy back stock, it supports market price. You could use those shares in mergers and acquisitions. You could use those shares in satisfying stock option plans for individuals. Now, earned capital. The earned capital is made up of two components. Right now, our focus will be on retained earnings. Accumulated other comprehensive income or loss, we'll talk about that in much more detail. But for now, let me just tell you what that is. It doesn't go on the income statement, but it's considered part of income. Example, personal illustration. You have a salary, and let's say you earn $60,000 a year. That would be going into your retained earnings. What if you had a portfolio of securities that you're holding, let's say, for a pension plan, and that goes up by $5,000? Is that part of your earnings? Would you report that on your tax return?
You don't sell it until.
Yeah, if you don't sell
realize
it, it's unrealized. So let me just give you the example again. You're making $60,000 a year, but your pension plan goes up by $5,000. Overall, your wealth went up by what? 65. But your earnings, realized earnings, are only 60. And that's retained earnings. The 5,000 is comprehensive income, is other comprehensive income. So when we look at this, it would be something, comprehensive income is equal to net income plus other comprehensive income. CI is comprehensive income. So your total wealth goes up by 65. And your realized income or your net income is 60, but your unrealized income is 5. So other comprehensive income are changes in wealth that are unrealized. Unrealized changes in wealth. So in other words, just look at it this way. What would you report on your tax return? 60,000. You wouldn't report 65, but yet you did pretty well this year. Your wealth went up by another 5,000. Right? So you wouldn't really report that. Okay, and the last, unless there are questions, anyone have a question on comprehensive income? It is a big change in the way we look at the world. What people do with comprehensive income, we don't know. But there is your income statement, for those of you who took accounting before, you might have seen this, but you may not have. Comprehensive income now is either a separate statement or it's on the bottom of the income statement. It's there. Whether it has the prominence of income or not in your mind or an analyst's mind is another story, but it's there. Now, in some cases, it does make sense because I'm going to say, all right, well, your pension went up, but the question is, if this was my profile, I'd say, well, he might retire soon, so maybe that means something to his, near-term wealth. In your case, it doesn't mean much. So you have to put comprehensive income in context of the company or context of the situation. It sometimes has a lot of use, sometimes it is not much, but it has some information, not as much information content as we would want. Okay. Now, just to remind you, and then we're going to take a break, to remind you about retained earnings, the idea of articulation. The way the statements feed, net income or loss, well, change retained earnings minus dividends, and that gives you the ending retained earnings. So just remember, beginning retained earnings on the balance sheet, plus net income minus net loss, or minus net loss, I should say, less dividends gives you the ending retained earnings, and that goes to the ending balance sheet. So remember the diagram we had, opening balance sheet, ending balance sheet, one of the changes is net income. Net income will change one balance sheet to the next.